In your money this week, stocks are at all-time highs, continuing the run-up that started last week when the two-week ceasefire was announced. U.S. stocks had actually sold off a month before the conflict started, and the international markets joined the sell-off when the U.S. campaign began. And as of midday today, global stocks are at new 52-week highs, and the VIX, which is a stock market volatility index, is down sharply, about 50% from its conflict peak. So are we all clear? The stock market's happy, but some important things are not back to where they were. The 10-year yield and mortgage rates and oil and gas prices are still higher. So what does this mean? The consensus seems to be, regardless of whether someone is optimistic or pessimistic about where we go from here, is that higher oil prices are inflationary and inflation and rates will be elevated for a while and growth dampening for the economy, which will prevent central bankers from cutting rates. A U.S. recession is still not the base case, but there are concerns and a bit more concerns about the global economy. That's what I've seen, and understanding the consensus is important since deviations from it can move markets, and it's helpful to understand the environment you're in when reviewing portfolio results and making planning decisions. But consensus clocking doesn't provide great opportunities to change your strategy or make portfolio changes. Those should be infrequent generally. I shared an article in my Wednesday reading list this week that the more investors trade, the worse they perform, and the investments they sell end up doing better than the ones they replace them with. I'll link to that in the video comments below. So just because we talk about the environment and we get into a discussion of how things are looking or what we can expect going forward, doesn't mean we run off and we make portfolio changes. I continue to think about portfolios these days in two ways. One, at some point, this secular bull market that we've seen in U.S. stocks will fade, and global diversification will reward investors. That did start. It paused for the war. And I wrote about this recently, and I'll provide a link in the comments as well, that the secular bull market that we've been in since the last bear ended in 2009, and the secular bull will have started a few years later when we reach new highs, has been going on for a while. There is no automatic endpoint to that based on calendars, but at some point, investors don't need to be concerned about the next 20, 30, 40% sell-off, which in a secular bull, you typically recover from quite quickly. But you do need to be concerned about a prolonged period of weak U.S. stock market returns. And to prepare for that, you don't abandon stocks. You don't start, doing goofy things with your portfolio. You diversify internationally and add some other asset classes, which again, I got into and I'll share below. Interestingly, the dollar, which had weakened until this conflict, and that supported international stock market returns leading up into the Iran war, the dollar has given up most of its war gains, perhaps restarting the support for international stocks. The second thing is the biggest investment opportunity right now to me is avoiding an investment mistake. And what do I mean by that? For one, I mean the market timing mistakes that people make during times of geopolitical conflict, confusing economic headlines, of which we have plenty, and those fantastic midterms coming up. I know no one can wait for that. Second, avoiding being concentrated in U.S. large cap stocks, which I just addressed. And then third, unlike other environments in my career, there don't seem to be obvious, strong opportunities to take advantage of financially that would cause people to shift their long-term plans. Just going back to 2000, in the aughts, people were making money in real estate and consumers were using rising equity in their homes to fuel consumption. Turns out that got overdone, which gave stock market investors in 2009 a generational low to capitalize on. Rates then went down to zero and stayed that way for a long time, fueling more stock market returns and also allowing smart capital allocators to use debt wisely to build wealth. And we've had some large stock market sell-offs during this secular bull that have provided great buying opportunities. And as I look at the landscape right now, I'm not seeing anything obvious or comparable. So the best opportunity is to stay the course and avoid a mistake and see what opportunities present themselves. And of course, to like this video, subscribe to the channel, check out the Boston Advisor for more relevant content. Astute observers will notice that Andrew didn't join me this week. He'll be back. But honestly, I felt like I carried him a bit last week, so we need him to regroup and come back stronger. I don't actually feel that, by the way, but now I'll know if he watched the video when he's not on it. He loves calling these solo videos of mine presidential addresses, since I just stare straight into the camera versus, turning to the right, give you this profile or the left. So I'll get some grief from him if he watched and on that comment. But more importantly, have a great weekend. Thank you for watching. and please find ways to support the channel so more people can see the content as well. Thanks.